The stock market and the bond market have both rallied sharply this month on the belief that interest rates have peaked and that the Fed will begin cutting interest rates before the middle of next year. The catalyst for this rally was Fed Chairman Powell's November 1st FOMC press conference, which was perceived as dovish. The S&P 500 index had fallen by more than 10% between the end of July and late October. But following Powell's press conference, stocks began to rise sharply, and the index has now regained nearly all of its losses. The yield on the 10-year government bond fell from 4.9% to 4.4% over the same period. Lower interest rates improve the relative attractiveness of stocks. However, the Fed will only begin to cut rates if inflation continues to slow. For that reason, any sign that inflation is cooling is likely to encourage investors to push stock prices higher, while signs of a rebound in inflation could lead to a significant stock market sell-off. It's important, therefore, to have a clear read on the outlook for inflation. This video will examine recent trends in inflation and consider the factors that will determine whether inflation accelerates or decelerates during the months ahead. The Consumer Price Index is the measure of inflation that attracts the most attention from the public. The year-over-year increase in CPI peaked at 9.1% in June last year. Since then, it's fallen to just 3.2% in the most recent month. And the month-on-month change in October was 0%, indicating no increase in inflation whatsoever last month. However, the Fed doesn't focus on the Consumer Price Index. The Fed's favorite measure of inflation is the Personal Consumption Expenditure Price Index, the PCE price index. That's the index the Fed uses to determine whether it's moving closer to or further away from its 2% inflation target. The PCE price index has also fallen sharply, from a peak of 7.1% in June 2022 to 3.4% most recently. That's a great improvement, but 3.4% is still well above the Fed's 2% inflation target. Notice that the average for the PCE price index from 2013 to 2019 was 1.3%, well below the Fed's 2% target. So during those years, low inflation was the problem. Inflation was too low. It was below the Fed's target, rather than the high inflation we've been experiencing recently. The data for the month-on-month percentage change in the PCE price